Houthi escalation threatens global energy arteries. The group's latest statement signals a direct intent to disrupt maritime oil and gas transit, injecting severe volatility into an already fragile market. The Houthi movement's official declaration of action against maritime targets represents a critical inflection point in regional conflict spillover.
This move explicitly weaponizes the Bab el-Mandeb Strait, a choke point for an estimated 10% of global seaborne oil trade and a significant volume of liquefied natural gas (LNG). The announcement, while anticipated, formalizes a high-risk operational phase that compels shipping insurers and major energy traders to recalibrate risk premiums and routing strategies instantaneously.
This deliberate targeting of energy infrastructure elevates the conflict from a regional geopolitical issue to a direct threat to global energy security and price stability, occurring amidst constrained OPEC+ supply and heightened winter demand.
The weaponization of maritime choke points' historical precedent demonstrates that even the threat of disruption in the Red Sea can trigger disproportionate market shocks. The strategic significance of the southern Red Sea and Gulf of Aden is not merely logistical but psychological within commodity markets.
Incidents like the 2019 attacks on Saudi Aramco's Abqaiq facility and the 2021 Ever-Given blockage of the Suez Canal established a market template where perceived supply risk rapidly translates into price spikes. The Houthi's proven capability with drones and anti-ship missiles, often supplied or technologically enabled by Iranian networks, creates a persistent, asymmetric threat that is difficult to fully mitigate.
The current global inventory drawdown and the lack of immediate strategic petroleum reserve releases from major consumers leave the market with minimal buffer against a successful strike, making trader sentiment exceptionally reactive to militant rhetoric.
Anatomy of an asymmetric market shock. The primary risk is not a total blockade but a cumulative risk tax of insurance, delays, and rerouted cargoes that tightens physical supply. A successful attack, or even a near miss, would trigger an immediate repricing of war risk insurance premiums for vessels transiting the region, potentially rendering some voyages economically unviable.
This forces a complex logistical recalculation. VLCC very large crude carriers and Qmax LNG tankers may divert around the Cape of Good Hope, adding 10-15 days to voyage times and absorbing significant global vessel capacity, thereby increasing freight rates across the board. The contango structure in all futures would likely steepen as prompt physical barrels gain a scarcity premium.
Furthermore, European gas markets, already sensitive to supply diversification away from Russian piped gas and reliant on Qatari and US LNG shipments through this route, would experience amplified volatility, potentially decoupling from US Henry Hub benchmarks.
Verdict: a persistent premium on crude markets will price in a new, enduring geopolitical risk factor, sustaining elevated floor prices for crude and LNG throughout 2024. The Houthi announcement institutionalizes a persistent risk premium of $5.10 per barrel on Brent crude, with spikes exceeding this range contingent on kinetic events.
The strategic response will involve heightened naval patrols by coalition forces, but the vast area and asymmetric nature of the threat preclude complete security. Consequently, energy majors and national oil companies will face increased operational costs and supply chain scrutiny.
The ultimate market trajectory hinges on whether this remains a contained nuisance or escalates into a broader regional conflagration involving Iran, Saudi Arabia, and international naval forces. Prudent strategy involves locking in term contracts for physical supply and hedging against volatility through options strategies, as the corridor's stability is now a permanent question mark.